Well, it's the 13th of March, my lucky number. There's a long story to that, why 13 is my lucky number. But anyway, I hope it's your lucky number too. And certainly if you've been investing in the Biznews portfolios, you've got a lot to be excited about. We have restructured the SA Champions portfolio, and we're reporting this time today for the very first time on the US Exponential portfolio, and that has been a rocket. It's come out of the starting stalls as a flyer, as we say in the racing industry, and I'll be taking you through that in just a little while. So we've got a lot to get through in the next hour. Let's kick off by giving you the mandate for the Biznews SA Champions portfolio, and that is JSE listed companies. In other words, only companies listed on the South African stock market, driven by the country's best entrepreneurs. So that's our mandate, and that's what we have stuck to there. Just to recap as well, we made some big changes to the portfolio, and there's quite an interesting story behind that one too. But the reason we made those changes was after the Ramaphosa election as the ANC president, our view was that the economic prospects of South Africa had changed structurally. There'd been a structural change in the long-term basis of the South African economy, and well, international investors felt exactly the same way. I've highlighted this from the Wall Street Journal graph. By the way, as a premium subscriber, Biznews premium subscriber, you really need to, if you haven't done it yet, you really need to action your Wall Street Journal subscription. You can get into the back end. They've got fantastic graphs, a whole data set quite apart from all the amazing stories that are available. But I think I'm actually going a little fast today. Stuart Lohman, our managing editor, is in Johannesburg. And Stuart, I haven't even brought you in to make sure that everything's on stream. You see, we've got so much room, so much ground to cover. I also want to get quickly out of this stores.
No, thanks, Alec. It's all good. I do know the US is going to consume a bit of the time because it's news. So just quickly, I haven't had any complaints, so I'm guessing everyone can hear me. I see a few hands already, so that's always good to see. If you can see Alec's graphs and you can hear my voice, just raise your hand. Excellent, that's perfect. And we do try to keep it conversational, very interactive. There's a little questions toolbar on the control panel, on the right-hand control panel. If you jot your questions in there, I'll pass them on to Alec as soon as they come through, and we'll try and make it conversational and get going. But Alec, let me not hold you up because I know there is a bit to get through today.
Indeed. So, right, just to confirm again what Stuart says, as you hear or as you would like to present your questions, please do so. So, the Rand on the 5th of November was trading at 14 Rand 37 against the US dollar. If you have a look at the graph now, it's comfortably below 12. So that is an improvement of 20% in the Rand's value. Why did I use the 5th of November? Well, that was about the time that we started getting some kind of an inkling that Ramaphosa could win the ANC elective conference. It really was a watershed moment when he scraped in just 90 people out of 4,700 who voted for him. Had they gone with the other side, then we would have had a continuation of the weakening of the Rand and a poor performance of the South African economy. It does, however, now mean that into the future, there is likely to be a far better performance for South Africa. And we're already seeing the feedback from the business community. In fact, we're going to talk about First Rand's results in some detail in just a little while because it is a member of our portfolio and they came out with their interims. But in that discussion, Johan Burger was very forceful and about the impact that Cyril Ramaphosa has for, or his election rather, has for South Africa. Let's look at the old portfolio before we go into the new, into the restructuring. There it is. The old portfolio, had we left it as it is, would be sitting today at 109,294 Rand. The new portfolio is 200 Rand lower than that. So not bad considering that we've made all the changes to the portfolio. But this is, if we'd done nothing, absolutely nothing, that was where we would be sitting. Catching up to the JSE All Share Index. Remember, we were pushed back a little by the holding of Steinhoff. We had 8% of our shares of our portfolio in Steinhoff. That was a disaster of note. We also had Brait in the portfolio. Thankfully, we got out of that before the disaster really hit. And then the other baddie was Mediclinic. But on the other hand, you can see very good performances by Naspers, Discovery, and First Rand. So all round, we're in front. The good news, very good news, is that the portfolio, in fact, was not restructured at the last session. On the 28th of February, when we had our last webinar, I gave you the changes to the portfolio. Those have taken a little while to get through the system at Easy Equities. And what happened was that the changes happened, were all done yesterday. So the portfolios have now been adjusted. The bundles, your bundle with Easy Equities in this portfolio was done yesterday. And the effect of it was that there was just a little bit, some of the share prices had actually done better than where they were on the 28th of February. And because this webinar is positioned on exactly what's happening to your shareholding, that's exactly what we've done. We've taken what happened with the, what prices the shares were changed at yesterday. Your portfolio, if like me, you're invested in the SA Champions portfolio, all the changes happened yesterday. It's been rebalanced now. We've brought in the Ashburton Midcap, Wilson Bailey, and Long for Life. They've come into the portfolio, and we've sold some of those Mediclinic and MTN shares out in their entirety, and then lightened the holdings of those three winners to get the portfolio correctly balanced. I hope that all makes sense to you. There's the new portfolio. As mentioned, it's about 200 Rand behind where it would have been had we not made any changes. So nothing really to get too worried about there. So far, so good with the newbies. In fact, they were only brought into the portfolio yesterday, so you can see that all three of them are slightly lower, but a fantastic performance in the portfolio by Discovery. That has been far and away our best performer. As you can see, 59% return, and we have 20% of the portfolio in that stock. In the last month, there's been a good uplift by our biggest holding, Naspers, gone from 3,245 Rand a share to 3,557. Discovery was up from 177 to 185 Rand, and Investec was up a couple of Rand from 102 to 104. On the other hand, the newcomers to the portfolio, well, they're pretty much where we bought them, as you can see from that net cost. And First Rand has come down after its financial results. It was trading at 74.50 2 weeks ago when we did the last update. It's now at 68.50. And that is after the interim results, which we're going to be spending a little bit of time on in a moment.
Sorry, Alex,
anything? Yeah.
Yeah, Michael just wants to know what happened to Mediclinic. I know you did mention it in the last webinar, but just what happened, why the sell?
Yes, Michael, it's a good question, and we did go into it in some detail in the last webinar, but there it is. Mediclinic was 15% of the portfolio, and which is a big chunk, and it has been a really poor performer. It cost us, well, more than 25, around 25%. There you can see we sold it at 100 Rand and 97, and we actually bought the Mediclinic shares at 133 Rand. So it was a real disappointment to us. Why? Well, we have restructured the portfolio on the basis that we're now looking at South African champions driven by entrepreneurs listed on the JSE. So we no longer, the mandate used to be South African champion is operating in the global environment, which kind of restricted your universe quite significantly. Mediclinic is not driven by entrepreneurs, it's driven by managers. We know that the chief executive, Donnie Manchis, is on his way out as well. He's being replaced by another professional manager. Hopefully there's going to be an improvement there, but it's not an entrepreneurially driven company. Whereas if you have a look at this portfolio, every one of them is entrepreneurially driven. You might argue that First Rand is not in that camp, but the three entrepreneurs who started First Rand have engendered that spirit and that culture throughout the organization. And if you see the new chief executive of First Rand, Alan Pullinger, is a highly innovative the person who used to drive RMB. Then you can see within the organization as well, Jacques Cellier at First National Bank is in a similar category, and so on. So we're quite happy to have First Rand in the portfolio as an entrepreneurially driven business. But if you look at the others, they all speak for themselves. So Mediclinic was a little bit of a sore thumb in that setup. By the way, you'll see we have Ashburton's mid-cap ETF. The idea there is to give the portfolio a little bit of ballast with an exchange-traded fund, which invested in South Africa Inc. So it goes down, and we'll talk about that in more detail, but it goes down into the second rank of companies. Many of them as well are also entrepreneurially driven. Stu?
That's it. Thanks, Alec.
Let's move on to the individual holdings in the SA Champions portfolio, starting off with Naspers. It's Bob van Dijk, who is also pretty entrepreneurial himself. As you can see, the Naspers share price this is a 1 year graph for Naspers. In the last month, it's done very nicely. It's come from 3,000 Rand a share to over 3,500 Rand a share. Now, Naspers, remember, is directly related to what happens to the Rand, the exchange rate of the Rand, and that dip in the Naspers share price was directly a consequence of the strength of the Rand, and to what happens with Tencent, which is one of the great entrepreneurial stories of China. Tencent I watch closely. I'm a huge fan of what Pony Ma is doing. I'm not the only one. It's now one of the top 10 companies in the world by market cap, and one of the biggest internet companies on earth. It still has lots of upside if you compare it with the American internet companies. And we unfortunately are unable to buy Tencent into our other portfolio, into our Exponential portfolio. We certainly would do it because Tencent doesn't really have a tradable market in its stock in the United States. It's only listed in Hong Kong. But when Easy decides to add Hong Kong to its setup, we certainly will be adding Tencent to our portfolio as well. Moving on to the next company, our big winner, Discovery. Discovery is about to launch a bank. I wouldn't get too excited about that, though. It's going to be a typical Discovery story where they'll take time to make money out of it. But elsewhere in the world, I was reading a little more about the Ping An story in China, and it is really a phenomenal business that Ping An has built there, and Discovery are their partners. And Ping An is a diversified financial services company in China, but their real focus is now on healthcare, i.e. the partnership with Discovery. So very exciting developments for Discovery. Already their joint venture with Ping An has got more than 4 million insured lives. And you just see how large the Chinese market and economy is. If you start researching more about that country and its potential to transform your investments, and the fact that it is still a pioneer market or a frontier market, I would suggest go onto the premium section and into podcasts, and go and have a listen to the podcast interview that I had, or the Rational Perspective podcast with Darby Kricher. He is the fund manager of the Cederberg Fund, which is invested only in Greater China. So he's made this a speciality for the last few years. And last year, he generated 75% return, top 1 percentile on earth. And he's a South African lad who is living in London. It's really a worthwhile podcast to go and listen to, the Rational Perspective. It's easy. Go into the premium section, have a look at the podcast area, and then just listen to the Rational Perspective. You can listen to all of them. I produce a few a week. And you certainly, going back to one of those that were produced in January, you'll read all about Darby Kricher. So if you read that or listen to that, you can read the transcript or listen to the podcast, and then think of what Discovery is doing there with Ping An. You just got to get excited about this company. It looks like the reassessment or the re-rating of Discovery is about to begin again. You can see it's kind of level pegged since mid-December. Came down a bit with the strength of the Rand there in early Feb, and with the decline in share prices of stocks around the world, but it's now picked up from there as well. There's Investec's 2 new chief executives. Both of them are very entrepreneurial. Fani Titi is the man behind Tiso, which is now well known in the media industry, for instance, with Tiso Blackstar, but it's also got a number of other businesses. He started that. He's now but he's been very involved with Investec. He's been the chairman of Investec in the past, and he's now joint CEO. And then on the right-hand side is Hendrik de Tooy. Hendrik was the man who started Investec Asset Management single-handedly. He literally began it with himself and a PA and a desk and a phone. That's how Hendrik got it going. And today, asset management is a massive enterprise, by far the biggest if you take its pound assets under management and compare that with other South African asset management companies. Hard to believe that those who've been around a while and have known that Old Mutual and Sanlam were the two dominant figures for so many years, that Investec have now sailed past them in terms of asset under management. So to have these two guys running the business into the future, as good as Stephen Kossef and Bernard Cantor have been, they certainly have passed on the mantle to good hands, and you can see what the market thinks of this. Going back to early December, there was a tanking of the share price, came down from 95 Rand to 85 Rand on the Steinhoff issue. Steinhoff, when Investec was able to show that its exposure to Steinhoff was limited, in fact, the big losers on Steinhoff, many South Africans are not really aware of this, are international banks, the big international companies. And as we're seeing the results coming out from JP Morgan and Citibank and others, we're seeing hundreds of millions of pounds and dollars being written off on Steinhoff. So Steinhoff is making those announcements for all the wrong reasons, I'm afraid. And it's substantial enough to impact these massive Wall Street firms that lent money to Steinhoff ahead of the collapse. Anyway, it didn't last long for the concerns around Steinhoff to dissipate on Investec. And as you can see, since the announcement of the new chief executives, the joint CEOs, there's been a sustained improvement in the share price. And if you'd bought it in mid-December, you'd be very happy today. I still think there is enormous upside in this company. It's a fabulous operation. They have got some of the best private banking products in the UK market. They're starting to really catch fire. And in South Africa, of course, when that country's prospects improve, it is around about half of Investec. Then clearly Investec itself will be worth a lot more money. So people like Investec for two reasons. The new energy that will be brought to bear by the new CEOs. They like the new CEOs, and also the rebounding in South Africa. Moving on to the Ashburton Midcap ETF. So this is the ballast, if you like, in our portfolio. 15% of it in this exchange traded fund. It'll give us a good feeling on how well the rest of the portfolio is performing as we go into the future. I just put there the top 20, which is about 2/3 of the portfolio for this ETF. And as you can see, the companies there, Foschini, Spar, Truworths, AVI, Life Healthcare, Netcare, Barterworlds, these are all South Africa Inc. type companies. So if South Africa improves, as our thesis says, with Ramaphosa coming in and with sensible economic policies being applied, then these are the kind of companies that will be back onto a growth path into the future. The movement in the price of this ETF has, as you could imagine, has been, well, it looks pretty volatile, but actually that's the from the top to the bottom. So it has improved since November, when we started getting an inkling that things could be better in South Africa from an economical structure, economy structures perspective, and you can see it's gone up there. But round about the price we bought, 770, 780, it's a good long-term holding. On to Wilson Bailey, and there's Mike Wiley, the chief executive. Financial results came out of Wilson Bailey, and they were pretty good. The share price, however, came under pressure, and that is because even better was anticipated. They had a bit of a tough year last year, or the year before, so it was coming off a low base, but still, this is a company that if you believe the story of South Africa Inc. Growing, you've got to believe Wilson Bailey is well positioned, or one of the best positioned to benefit from it. And that's really what it's about. If an economy expands, and especially an economy like South Africa, which is looking to China, to the success models that were achieved in China, and to try and replicate them in South Africa, The success of China was largely built on infrastructural investment. That gave the economy the kickstart that it needed, and you're seeing it here in Wilson Bailey starting to lift its head up after coming back. We bought the shares yesterday, so right on that or simple moving average chart. On to First Rand, there's the new chief executive or chief executive designate, Alan Pullinger. And First Rand's story is where we pause a little to go into some detail. Before we do that, Stu, is there any more questions?
No, so nothing this side, Alex, but quiet in the questions chamber today. So we need to encourage some participation.
I see the questions. There are a few, but they're more comments than questions. So I suppose the participation's there, but I'm running through this. I guess you don't want to miss anything. Let me tell you about First Rand. Today, First Rand, it's a big day in First Rand's life because the Aldermore acquisition is now completely confirmed, and that is the 1.1 billion pound, call it 20 billion rand investment into the UK. Essentially, what's happening at First Rand is that they are going to have 5 brands now, of which Aldermore will be one. The others being First National Bank, Westbank, RMB, and Ashburton. So those 4, FNB is the retail bank. It's by far the biggest part of the company, generated in the 6 months to the end of December, 58% of their overall profits. RMB is number 2, and that generated about a quarter of the overall profits. Then you got Westbank, which was slightly lower in the 6 months to December, and that's probably the major reason why the share price dipped, as you can see. After the results were released, was in the mid-70s, came down to significantly below 70, around 68 rand a share, and that's primarily because of Westbank. And now Ashburton is the asset management side, which is still finding its feet, if you like, from a profitability perspective. And then the big one in the UK is the Aldermore, which was acquired. It was a listed company. It is going to delist on Thursday, and then completely merged with Moto Novo, which is the first step that First Rand made into the UK market, financing effectively second-hand cars using what it understood from Westbank, applying that into the UK market, and it makes 500 million rand a year in profit. So a significant operation. By putting it together with Aldermore, you're going to have a strong base, have cheaper funding for Moto Nova, for the second-hand financing business. And on top of that, you avoid the problems that South African banks are having funding because of the sub-investment grade or the junk rating of South Africa. That what many people don't understand, what we look at with a junk rating is the problem that comes in for the country as a whole. The country will pay more in interest, but we pay more as consumers as well, because the banks have to pay more for their funding. They get a lot of their funding from the international markets, and with sub-investment grade, that is where the banks' ratings are based on where the sovereign is. In other words, South Africa goes down as a whole, and then all the banks, which have to borrow in the marketplace to fund their businesses, they also go down as a rating, so they pay more for their borrowings. That's essentially the way that it all works out. Now, if you've got Aldermore based in the UK, it has got no impact. The South African sub-investment grade rating has no impact, which means you get the funding cheaper for both Aldermore itself, which has always had it, but also specifically for Moto Nova, which is your substantial second-hand car financing business. As far as the results were concerned, they were solid. First Rand produced 7% improvement in earnings. It raised the dividend by 9%. This is for the 6 months to the end of December. The share price, however, was down 4% on that move. Why so? I think it's to do. It can't be to do with the underlying performance. Return on assets were just slightly down from 2% to 1.99%. Return on equity, 22.5%. Every area of the book is looking good. In fact, they moved into unsecured lending, or they have been moving into unsecured lending, which is where Kappa Tech plays. And if you actually just dwell on that for a minute, the reason why Kappa Tech is so profitable is evident in the First Rand numbers, where mortgages make about half of the lending in the retail market for First Rand. So roughly half of the of the money that it's lent out goes into houses. The money that FirstRand is lent out to individuals, so the retail market they call it, goes into home loans. The margin there, the profit margin there, is 1.9%. Okay, quarter 2%. The profit margin on unsecured lending, where they now have about an eighth of their lending, does FirstRand, is 12%. So as you can see, the unsecured lending market is a lot more profitable than the traditional home loan market. And the big banks like FirstRand and others have been going into unsecured lending in a very measured way, not ensuring that it doesn't get too big as part of their market, but it's a bit like a sweetener to their profits, if you can imagine. Then you look at Kappa Tech, and Kappa Tech is there full on. So its margins will be much higher, as you can see, from that 6 times higher than traditional banking business. That might help a little bit to understand the Kappa Tech story. Of course, Kappa Tech will have a higher bad debt ratio because you make a bigger return on riskier business. And Kappa Tech has been attacked on all kinds of nefarious reasons. Again, go and listen to my podcast on that one. I had an interview with Gerry Fourie from Kappa Tech over the weekend, and that Rational Perspective podcast is up on the Biznews Premium today. So you can go and listen to it, and you'll get a very good understanding from that, how Kappa Tech have handled this attack from Viceroy, and why I think that Viceroy are not really fully understanding the Kappa Tech story. They're looking at Kappa Tech as you would a legacy bank rather than a bank that was started fairly recently and is based on technology and very strong tech systems. Anyway, that's my view. There are lots of people who are much smarter who think differently, but that's the way I read that one. Going on to back to Rand. Sorry, Stu.
Sorry, Alec. Just come in there quickly. Just on Kappa Tech, you speak of Kappa Tech quite highly. It's not in the portfolio. Just a question on why.
Too expensive. It's just a simple reason of price. The Kappa Tech price to book is around 6. FirstRand is 3.5, and that's really the. I think that I do like Kappa Tech. It's a good business, and I've done enough. I went to visit them 4 years ago. In fact, it was Rands, the chief executive's final day, the founding chief executive. It was his last day at Kappa Tech, and I'd been quite critical of them, and I went in there, asked the right questions. I think anyway, and I got to see an extraordinary operation. They are based in Stellenbosch. Their offices are very, very modest and humble. The chief executive and the financial director have offices next to each other, which I think are smaller than any even mid-ranking bank manager in one of the big 4 banks, for instance. It's a phenomenal business, but is it worth price to book that is nearly double or virtually double that of FirstRand's? I don't think so. I think that it's just too expensive. But remember, you've got to buy when you're investing in something. You've got to make sure that you buy it at the right price. And for me, if Kappa Tech were to come back much more, then it would start getting, if it came back to the same level as FirstRand, for instance, it would start getting very attractive. And part of the reason for that is, as you can see, the market they're operating in, and it's almost, the runway is almost infinite, unsecured lending. As long as you get it right, as long as you don't lend unsecured to the wrong people, and as long as your systems are all correct, your margins are going to be higher than traditional banking for a long, long time. So I like the business, but I don't think that the rating is warranted.
Excellent, thanks, Alec.
Just to close off then with FirstRand on this side, the other reason why the market had a look at them a little negatively after really pushing up those shares ahead of the results, I think has got something as well to do with the caution that the FirstRand team gave back. You will remember, and you can see it very clearly there, mid-December, you'll see the share price was in the mid-50s. It surged on the Ramaphosa effect, if you like, when Ramaphosa was elected as ANC president, and then not long afterwards to become the country's president, for reasons that we also fully agree with. It's definitely is a change in the country's prospects, but is it enough? Is that enough to have justified a surge in the share price to the degree that it was? When the FirstRand team, Johan Berger, the outgoing chief executive, did his presentation, he explained that it's, in their view, it's going to take quite a while for the practical impact of Cyril Ramaphosa to start working through the economy and his different approach to things. And in fact, they said, do not expect more in the second half of the financial year than we delivered to you in the first half. And they only delivered a 7% growth in earnings in the first half. So they're saying for the 6 months to the end of June, not going to be terribly exciting either. Hopefully thereafter, we can start getting upbeat once more. But after that, a sense of realism came back into the investor thinking, and the reality of South Africa's situation became more apparent, and hence the FirstRand share price going back. I hope that kind of sums it up well. We like it as a long-term holding. We think that, relatively speaking, it is still very much more highly rated than the other banks, excepting for Kappa Tech. You put Standard Bank, for instance, is at about 2/3 of the rating that FirstRand is at. So I still like Standard Bank, Nedbank, and Absa as well in there, and not as well rated as FirstRand. So there's a lot of expectation that is built into this company. But on the other hand, they have delivered. They've got top management, and will they deliver into the future? Certainly, everything we've seen from them suggests so.
Sorry, Alec, just quickly on FirstRand. Shirley wants to know, would you buy it at its current price?
Yes, Shirley, I would certainly be doing that. And in fact, that's what we do. Every month that with the Easy Equities bundle, with the Biznews SA Champions bundle, if you put in 250 Rand a month, which is, I think, the minimum that is required, you're buying the whole bundle. So you would be buying 8% of that 250. What would that be? 16, 20 Rand. 20 Rand will be going into FirstRand, into some percentage of a FirstRand share. Yes, all of the stocks in this portfolio I would be buying at their current levels. And in fact, we are, because as you allocating every month, you're buying your Rand cost averaging, as they say, but you would be buying a few of the shares. As the share price goes up, you buy relatively fewer. As the share price goes down, you buy relatively more. And that's what gives you this beautiful thing called Rand cost averaging, which is one of the benefits of what Easy have put together with their bundles. It's actually incredible that, imagine you go to another stockbroker and you say, I want to buy 20 Rands worth of FirstRand shares. They'd charge you 150 Rand to buy your 20 Rands worth of shares, whereas with Easy, it's in that bundle. So you get your percentages.
Thanks, Alec.
Moving on to another great entrepreneur, Brian Joffe. His little introduction. Long for Life is a stock that we are very happy to be holding. It's around about the level, 5 Rand 62. I was unfortunately we were wanting to buy this one some time ago. Certainly when it got below 5 Rand a share, it was screaming out at us, because at that level, that's Brian Joffe himself put 100 million Rand of his own money into Long for Life at 4 Rand a share, and he's running the business. His backers, his supporters from the beginning put their money in at 5 Rand a share. So when it was trading, as you can see earlier this year, at below 5 Rand, it really was a screaming buy. But we only did the purchase yesterday, although we did say that anybody who'd bought Steinhoff, when we dropped Steinhoff out of the portfolio on the 9th of December, you might recall what happened. The 7th of December, the news came out that the auditors refused to sign the accounts, that all the stories Steinhoff had been telling us were actually wrong, that the chief executive had resigned. And then it took only 2 days. The first day I tried to find out what was going on. The second day I had found out enough to say, whoops, let's do the Buffett deal here and drop Steinhoff in its entirety. We did, but there's still people who put in money every month into the Biznews SA Champions portfolio, into the bundle. So for those people, we said the money, instead of going into Steinhoff, that would be going into Long for Life. So if you're doing the monthly deposit or the monthly investment, you would have a few long for lives there at a pretty good share price. But even so, at R5.60, it's a good price as well. I'm very happy with this one.
Alec, you just touched on Steinhoff there. Willem wants to know, what do you anticipate the effects of Steinhoff to be on the annual returns of the portfolio?
Well, it's gone, Willem. It's out. The portfolio we don't have Steinhoff in it anymore. We sold out in its entirety on, I think it was the 9th of December. I think we got R6 a share or something, which doesn't really matter. It meant our 8% that we'd invested in Steinhoff was wiped out, was gone. We took a 92% knock on that. But fortunately, it was only 8%. And actually also fortunately, because the rest of the portfolio had performed so well, I think it had come down to something like 6% by the time, or ahead of the collapse of the stock. So it's out, and the portfolio, as you see, with a 9% return since launching in January last year, is what you get. That's what you get. I look at my return through the easy portfolio, and it shows what we've made since that period of time. So Steinhoff's out, and there's no more exposure to it.
Thanks, Alec.
Okay, and there it is. Actually, Willem, I should have put this up there. As you can see, that's our portfolio. There's no Steinhoffs in your account if you have the bundle. It's gone, and you can see that the bundle is now already in just a month since we'd made a few changes. In fact, you can see Naspers is at 26% rather than 25%. Big rebound in the last month. And Discovery being our best performer there. And the three newbies that have come in, Ashburton, Wilson Bailey, and Long for Life. Total return of this portfolio, so for the 100,000, just to put it differently, the 100,000 Rand that we started with on the 23rd of January last year is now worth 109,000 Rand, and that's after selling out of Steinhoff. So, and Brait and Mediclinic. So our three baddies, three laggards or disappointments have gone, and the real money, if you liquidate your portfolio today, you'll get 109,000 Rand back for 100,000. So it's a little below the all share index, which is at 11.7. So if you had invested just in the all share index, you'd be sitting at 111,700 Rand. So put it differently, we're at 109. But I'm confident that we're well positioned now to outperform into the future. Makes a lot of sense, Stu.
No, it looks good, Alec. Yeah, all good. I think it's time for the US stuff.
I know you're also a shareholder in that portfolio, but let's look at the really exciting one, and that's the Exponential Portfolio. Well, we are expanding as Biznews into the global environment because we've realized that there is a part of our philosophy is to inform African investors, or South African investors, I suppose, primarily, about what's going on in the rest of the world, and the rest of the world about what's going on in South Africa. So that's why we're expanding here. And when Easy Equities launched its US offering, in other words, the opportunity for South African investors to buy into American shares, and that was in November last year, we got together and we said, well, let's put together another bundle. And that bundle is called the Biznews Exponential Portfolio. And you can buy it in the same way as you buy the SA Champions portfolio. The mandate here is US listed companies with exponential growth potential. What's exponential? That means more than single digit figure growth potential. Those companies that can really surge into the future. And that is the portfolio as it is. You'll see there that we have put, again, a little bit of ballast. And our ballast here is the Vanguard S&P 500 portfolio. We started off with 25% of the portfolio in that, as well as 25% of the portfolio in Amazon. You can see both of those. We put, if you go across to the cost in dollars, $24,600 went into Amazon, and $24,790 went into the S&P 500 index. And Amazon has been just the best share. I love this share, and it continues to give us such a wonderful return. I know the story. I followed them for a long time. I am a huge fan and remain a fan. We bought in November in this portfolio at just over $1,000 a share. It's now nearly $1,600, and that's only in 4 months. And that's the primary reason why, if you go and look down on the bottom, this portfolio has gone from $100,000 to $122,000 in just 4 months. So clearly outperforming the other portfolio by quite a margin. But remember, this is in the exponential area. It's in US stocks only, and it is basically a US dollar return. The Rand has appreciated against the US dollar, so you got to, if you invested in Rands, you got to moderate that return a little, but it still has been a fantastic investment. The every member of this portfolio has improved. We did decide to drop Tesla. Now, there is a story for you. We did this change yesterday. I'm really worried about Tesla. Tesla, although it's run by a South African and we've got this affinity for Elon Musk and everything that he does, his predictions and his forecasts are making the short sellers even more bullish about how they're going to knock this company on its backside. Short selling is the way that you take a position anticipating that the share price of the company involved is going to fall. And there's a bigger short position in Tesla than any other company listed on the New York Stock Exchange or NASDAQ. So of all American companies, the most negative by those people who are betting against them is Tesla. And Tesla isn't doing much to help its own case in this regard. The Model 3, which is the model on which Tesla will be judged into the future, this is the $35,000 electric car that is supposed to be a mass market opportunity for Tesla. They're supposed to, by this stage, and be 5 months into the production cycle, be producing 5,000 of them every week. The number was down at 700, and they've actually suspended production for a few days to try and presumably find out what's going on. Every time Elon Musk appears in public, though, he gives people confidence. He is a most impressive character with a wonderful story, and the share price seems to recover again. I see it was up at $340 last night, just after we sold at $327. We made a small profit on this of 6%, but I'm really worried that there is a potential here for a bit of fallout if he doesn't deliver the goods when the next set of quarterly results come out. And the Americans are extremely harsh when it comes to an inability to deliver what you promise. Elon Musk has been promising, and if he does deliver in March, well, then the share price would be perhaps sustainable, or it would be justifiable. But there's a huge short position here, and if he doesn't deliver, it'll be like the predators jumping in. We bought in our other portfolio with Standard Bank, we bought into Tesla at $200 a share, and even there, I'm nervous about it now and thinking that it's perhaps time to just allow discretion to be the better side of valor, because you can't continue to not meet your targets or not meet your promises and expect that there won't be any impact. On the other hand, I've been looking for an excuse to buy Alibaba, and here it is. We've bought them into this portfolio. We've taken the Tesla investment and we switched it into Alibaba. What is Alibaba? It's a wonderful internet company in China, one of the big three there. Baidu, Tencent, and Alibaba are the big three. It's run by Jack Ma, and Jack Ma is the richest man in China, or depends on he or Pony Ma, same surname. In fact, Ma seems to be a very good surname to have if you're in business in China, because the man who runs and founded Ping An, which I told you about earlier with Discovery, his surname is also Ma. So you've got these three Ma's, unrelated, all of them, who are incredible business entrepreneurs. And Jack Ma is the man who drives Alibaba. It's the one that is listed on the New York Stock Exchange. And compared with the South African business, with the US businesses, it is a still a very good value. So we bought into Alibaba, we've got out of Tesla, and we'll have a look at the result in time. Just to go through the different companies very quickly for you. Here's Amazon. The improvement in this share price just continues. In the other portfolio with Standard Bank, which was launched in December 2014, we bought Amazon at around $350 a share, and you can see that was not even 4 years, 3 years ago, and it's now sitting at $1,600 a share. So will it go to $3,000 a share? Who knows? All I can tell you is that Amazon's business model is irresistible, and every time that Amazon moves into a new market, it seems to be able to dominate it. What does it do? It puts the customer at the center of its business, and it keeps its profit margins low. So it produces a disruptive force which is wiping out entire companies in other areas. We saw, for instance, one of the well, it started off in books. It sold books. Then it moved into retailing generally. And it wasn't long before Amazon started cutting back the market value of Walmart. Warren Buffett saw this coming, and he sold Walmart a few years ago. It was one of his top holdings 5 years ago. He doesn't own any Amazon shares because he's unable to predict where Amazon will go in 5 years' time, but he certainly has been effusive in his praise of Jeff Bezos and his company. Amazon's latest trick is moving into healthcare. It's a slow business. This is the first time that Warren Buffett has done a deal with Amazon. They're partnering together with JP Morgan, and the idea on healthcare is that they will produce for those three companies a healthcare system, which they will then later on roll out to the rest of the world. And it's interesting that Apple, who's also which is also in our portfolio, has done something similar. More of that in a moment. Here's the second holding in this portfolio, the other one where we put 25% in each from stock. This is the S&P 500. So your portfolio performing relative to the overall stock market, and there's the overall stock market in the United States. We had a what they called the Trump rally, which began well over a year ago now, and then you had that sell-off in early February, which was quite significant, but the overall market in the United States picking up from that level. Google has had was badly hit by that sell-off. We saw about 10%. So what we have is 25%, 25%, the two big stocks. Well, the exchange traded fund, the S&P 500, and Amazon, our big stock. So 25 to 25 is how we started, and then we have 10% in each of the others, and 5 stock picks, and one of those is Google, which, as you can see, is moving up in the right direction. Google has got a portfolio of bets. Clearly, at the moment, it makes all of its money from online advertising, where it is the dominant player. That advertising is built off its search functions, where it's a dominant player as well. So that's where its cash cow is, but it's taken that money and put it into things like autonomous cars, driverless cars, and so on. Then there's Apple, and what Apple has done is very similar to what Amazon did. It has now launched its own healthcare business. It's just for Apple's own staff. So it's a technology-based healthcare. And I wonder if there is somewhere over here between Discovery and Apple a deal to be had. Because if you consider that Discovery is the biggest purchaser worldwide of Apple Watches, which it then sells to or passes on to its and we're talking about Discovery through Ping An in the China, through John Hancock in the United States, and its wholly owned subsidiary Vitality in the UK, and of course Discovery in South Africa. So through all of that, what it says to its customers is, you make yourself better. This is what Discovery does, and we will share with you the savings that you have that if you didn't get yourself better. And one of the ways of making yourself better is by buying an Apple Watch, but we won't charge you for the Apple Watch as long as you exercise. So if you exercise, we bet that you're going to be doing so much, your mortality rate is going to fall so much, and your health is going to improve so much that you're actually going to be making back the cost of that Apple Watch. Apple itself is now, of course, going to be using its own Apple Watch for its own wellness program, for its own staff. And you got to wonder, is there a deal somewhere along the line between Discovery and Apple? Who knows? These are these are just speculations on my side, but stranger things have happened. Moving on, and you can see there, Apple's moving $380 a share to an all-time high.
Thanks, Alec. I think
There's Facebook.
broadband.
This is one I'm sketching.
Sorry, Alec, I think the broadband's getting a bit jumpy on our side. There's a question from John. I'm not sure if you want to answer or just run through things quickly, and we can try to pick it up afterwards to see if the broadband holds up.
I'm happy to do that, Stu.
Okay, cool. Do you want to run through the stocks and then we'll pick up after, just so we don't miss anything?
Yeah, let's do that. We got 10 more minutes to go with the webinar, so I'll go through the stocks very quickly, and then we can pick up the questions at the end. This is one that's bothering me a little bit. I'm still a big fan of the social network and the factor that it has, but Facebook has hit a little bit of wind in its face. There's also other social media options, and we know the Russian fake news story for Facebook. So as you can see, the share price didn't really recover as strongly as it might have after the February decline. And then here's one that is just going gangbusters. Very happy to have Microsoft in our portfolio. It's up more than 20% since November, as you can see there. Very strong performance by this company. And the story that we bought into here was the change in the whole billing system. With Microsoft in the past, when you wanted Microsoft Office or any of those products, you would buy or even Windows, indeed, you would buy it from a retailer and then install it in your machine. You might buy it offline, online as well, and then you needed to update it and upgrade, etc. Microsoft has shifted that whole business model to an annuity income. So, to an automated income. So you pay per month or you pay per annum, and then you update as you require or as the software is updated, and it means you're in forever. It's a fantastic business model, and it's also a very good one for the consumers too. Microsoft has just declared a dividend of 42 cents per share, was actually declared last night, and that's 42 US cents a share, and it'll be payable on the 14th of June. You have to be registered, I think, the 17th of May. That puts it on a forward yield of about just under 2%, which in a United States where you are getting only that much on treasury bonds is a pretty good, a pretty appealing investment for most. And then closing off with Alibaba. As you can see, since November, whereas some of the other stocks, our overall portfolio is up, as you know, by 23%, Alibaba's done very little. So it's the time to move out. We've made a small profit on Tesla, 6%. That's not the reason we're selling it. We're selling it because of the concerns that it's not delivering on its promises, whereas Alibaba is one of those stocks that just keeps on delivering on its promises. So that, Stuart, is the Exponential Portfolio. As you can see, a return of 23% in 4 months. I don't even want to go there on annualized growth, because that sets expectations that can be pretty scary to try and fulfill. But if we could make 10% a year in US dollars, you'd be doing really well. Well, we're at 23 at the moment after just 4 months. So we're in a nice place. As you can see, the Vanguard, the S&P 500 index is up 9%. Am I worried that it's gone too far too fast? No, not at this point. I'm quite comfortable that this is the side of the market that we're invested in with the exponential companies that are disrupting the rest of the business environment around the world, and certainly in the United States, and it's the place to have your money.
Excellent, thanks, Alec. I've just got a couple of questions. John wants to know, if one is already invested in the global portfolio, would there be any reason to also invest in the Biznews Exponential portfolio?
Yeah, John, it's I think the global portfolio has been a phenomenal performer. This portfolio with easy equities is more for the person who just wants to put their money in and just let it not have the hassle about deciding which to rebalance themselves. Remember, with a global portfolio with Standard Bank, that is one that is aimed at people with web trader accounts, and it is, if you like, for the more sophisticated investor or for the person who's got a little bit more time. So it also includes stocks that are outside of the US, whereas the easy equities portfolio is only in the US. For instance, in the global portfolio, we've got Metro Bank, which is starting to move quite nicely recently, and we've got Tencent, which has been a great performer. We don't have those two in the Exponential portfolio because neither of them are listed in America. However, the appeal of the easy equities portfolio is for the, I won't say the first time investor, but the less sophisticated investor, the person who just wants to put their 200 Rand, 500 Rand, 5,000, 10,000, whatever it is, every month, and then to get that spread automatically by easy equities into these stocks. So, yeah, I hope that explains it.
Thanks, Alec. Marcel just wants to know, can we invest in Rands?
Yes. What happens with the Exponential portfolio is that up to $1 million Rand, you can invest now. You can convert it now into dollars, no questions asked. So if you talk to the guys at Easy Equities and you say, we want to put the money, I want to put 10,000 Rand into the Exponential portfolio, they will guide you through. It's really that easy. In the past, because of exchange control, that was it was a problem where you had to physically apply for permission to move from Rands to dollars. But as long as you do that now, within that limit of $1 million Rand, and that's what you're given per annum. So it makes it very easy. In fact, the whole thing of easy equities is really, really easy when it comes to investing both locally and internationally, because the bundles, those two bundles that we've spoken about now, the SA Champions and the Exponential, are even for people with very modest means. If you've got 250 Rand that you can afford to put into it, you can play, you can get involved. It's that easy. So I think they really deserve all the accolades they've got for their innovation and for bringing investing to the ordinary man.
Excellent. It looks like the final question, Alec, unless someone slips one through late just now. It's from Dirk. He says, I have an equal amount in the Vanguard ETF via WebTrader and in core shares S&P 500 via Easy Equities. I'm considering selling my Vanguard ETF and making an additional investment in Amazon. Your thoughts on Amazon outperforming the S&P 500 in the medium to long term?
Interesting question. If you already have both of them, first of all, Vanguard is a very efficient vehicle. The reason I like it is because its total costs are 4/100ths of 1%. So, and the reason its costs are so low is because it's so big. So what Vanguard does is it reweights on the 500, and obviously there's some costs in that when you're buying and selling shares and allocating them. But it makes up those costs by lending out stocks to short sellers. So if you want to sell short, in other words, you want to get, you believe you can make money by selling Tesla today, but you don't own any stock because you think the share price is going to go down. What you do is you go to someone like Vanguard and you borrow Tesla shares from them. You then sell those on the market, but with the understanding that you would have to give back the Tesla shares to Vanguard at some point in time. And Vanguard will sell you, will charge you for that privilege. That's how Vanguard makes so much money. And then that money goes straight back into offsetting costs. So the total cost for Vanguard is 4/100. In other words, 0.04%. I think it's a fantastic vehicle to buy the market. And that's why it tracks the US market all the way. The real question you ask, though, is should you be going from the market overall into Amazon.com? And given, I guess, the fact that Amazon's up 56% already in the last 4 months, is it not too expensive now? From my perspective, I would be very happy having, if there was one share that I owned in the whole world, I would be happy having it as Amazon. Amazon is maybe the way to look at this is look at the Amazon business model, which is something I absolutely believe in. And it is a irresistible model. It's a model of scale. It's a model of putting consumers at the middle of your market. It's a model of momentum, And as you grow, as Amazon Prime grows, you get the network effect, you get the scale effect, you get all of these benefits. Is that a business model and the average business model of American stocks? I would say unquestionably yes. So if you were to bet on the two, if I was forced to, I would say that Amazon is the one that's going to give you the better performance. Vanguard will give you more stability, perhaps.
Excellent. Thanks, Alec. That's a very nice place to leave things for today.
Indeed, it is, and we're exactly at 1:30 in South Africa, and we've been precisely an hour. Thank you for joining us. Good to see so many people participating today, and the attentiveness being so high. It's been fun, and I look forward to updating you again on the portfolios, on both of the portfolios. We're going to do that in future. Mid-month, we'll be talking about the two easy equities portfolios, and then end of the month, we'll talk about the global portfolio. And I don't think it's going to take a genius to work out that the changes I was proposing or suggesting that would be made in the global portfolio at the end of the month, the end of this month, are likely to happen as we've dropped Tesla here and brought in Alibaba. I'll give you more update on Alibaba then. Thanks for being with us. And from me, cheerio. Stuart?
Yes, thanks, Alec. We'll chat in 2 weeks' time.